If you want real financial growth in 2026, you need more than motivation. You need a proven blueprint. In this video, we'll break down the top investment tips that can help you build wealth, reduce risk, and make smarter money decisions in today's fast-changing economy. Whether it's stocks, digital assets, or long-term strategies, this guide will help you invest with confidence and clarity. Let's design your path to financial success. 1. Build a foundation through diversification. A strong investment strategy starts with spreading risk across multiple asset classes. In 2026, investors are dividing their capital between equities, bonds, real estate, commodities, and digital assets. The goal is to create balance so that one downturn does not destroy overall growth. For example, while technology stocks may fluctuate, gold and real estate often provide stability. International investments also help reduce dependence on one economy. By diversifying across industries and geographies, you create a portfolio designed for resilience and steady expansion. 2. Invest in the industries driving the future. The most successful investors in 2026 are focused on where the global economy is heading, not where it has been. High-growth sectors include artificial intelligence, cloud computing, renewable energy, electric vehicles, biotechnology, and cybersecurity. These industries are benefiting from both private innovation and government support. AI companies are transforming healthcare, automation, and finance. Renewable energy firms are expanding rapidly as the world transitions away from fossil fuels. By aligning your portfolio with these structural trends, you position yourself for long-term growth rather than short-term speculation. 3. Strengthen your portfolio with income assets. Cash flow is a key element of professional investing. Dividend stocks, income ETFs, and real estate investment trusts provide consistent returns regardless of market volatility. In 2026, many investors are reinvesting dividends to compound their wealth. Over time, this creates a growing stream of passive income that supports financial independence. Instead of relying solely on market appreciation, you benefit from regular earnings that stabilize and accelerate portfolio growth. 4. Apply dollar-cost averaging for stability. Trying to predict market highs and lows is a losing game. Professionals prefer a consistent investment approach. Dollar-cost averaging involves investing fixed amounts regularly, allowing you to build positions gradually. This reduces emotional pressure and protects against buying heavily during market peaks. Over time, it creates a smoother and more disciplined path toward wealth accumulation. 5. Expand into emerging global markets. Economic expansion is strongest in developing regions. Asia, Africa, and Latin America are becoming major contributors to global GDP growth. These regions are seeing improvements in technology adoption, infrastructure, and financial systems. Investing in emerging markets provides exposure to younger economies that are growing faster than developed nations. Funds and ETFs tracking these regions allow you to participate in global growth while reducing geographic concentration risk. 6. Balance growth and security. Professional investors do not put all their money into high-risk opportunities. Instead, they maintain a healthy mix of aggressive and conservative investments. In 2026, growth assets like AI and crypto are balanced with stable options like bonds and money market funds. This ensures that portfolios remain protected while still benefiting from innovation-driven expansion. 7. Protect your capital with risk management. Smart investing is about survival first, growth second. Investors are using stop-loss limits, hedging strategies, and asset allocation rules to protect against sudden market crashes. By limiting exposure to overly volatile assets and maintaining emergency liquidity, investors stay prepared for economic uncertainty. This discipline prevents emotional decision-making and ensures long-term financial health. 8. Understand and adapt to economic cycles. Markets move in cycles of expansion and contraction. In 2026, inflation, interest rates, and central bank policies are shaping investor behavior. When rates rise, bonds and savings instruments become more attractive. When rates fall, equities and real estate typically gain momentum. Aligning investments with macroeconomic conditions is a critical part of the financial growth blueprint. 9. Combine technical and fundamental analysis. Professionals evaluate both company performance and market behavior. Fundamental analysis identifies financially strong companies, while technical analysis helps determine entry and exit points. Using both methods together improves timing and ensures that investments are backed by solid financial health and market momentum. 10. Use technology to improve efficiency. Investment platforms and fintech tools in 2026 offer automation, portfolio tracking, and real-time analytics. These tools reduce manual errors and help maintain disciplined investing habits. Investors who leverage modern financial technology are able to rebalance portfolios efficiently and make data-driven decisions faster. 11. Optimize for tax and regulatory changes. Understanding how taxation affects your investments can significantly increase your final returns. Investors who hold assets for the long term and use retirement-focused accounts are able to retain more profit. Global investors also pay attention to regulations surrounding digital assets and emerging markets to stay compliant while maximizing returns. 12. Maintain emotional and strategic discipline. The final element of financial growth is mindset. Professionals do not panic during downturns or chase hype during bull markets. They stay focused on long-term objectives. In 2026, successful investors remain calm, consistent, and disciplined. They treat investing as a system rather than a gamble, ensuring that every financial decision supports sustainable wealth. The financial growth blueprint for 2026 is built on diversification, innovation, discipline, and patience. By focusing on future-driven sectors, managing risk, and maintaining a long-term vision, you can transform your investments into a reliable engine for wealth creation. Apply these principles consistently, and you will be prepared not just for 2026, but for the decades of financial growth that follow. Now you have a clear blueprint to grow your finances in 2026. The key is consistency, patience, and smart decision-making. Apply these investment tips, stay informed, and keep improving your strategy. If you found value here, like, subscribe, and share this video with others focused on financial success. Start building your wealth today and make 2026 a year of real financial progress.